Mortgage rates don't just follow the Fed. This week proved it yet again. We had a stronger report for gross domestic product, tighter jobless claims, and bond market pressure, which is really steering the ship right now. Rates dipped earlier this week, but by midweek, stronger economic data and bond market stress pushed things back up just a little bit. So if you think rates are a straight line based on the Fed, you're missing half the story. So I'm going to dig into some of the details that a lot of people aren't talking about. According to Freddie Mac's data, after several weeks of decline, mortgage rates nudged higher again. The 30-year fixed average moved up very slightly. Wasn't tremendous, but it was upward pressure. The bond and mortgage-backed securities market showed some signs of weakness. Mortgage-backed security prices are moderately weaker today, which means yields rising. In other words, that's where we got our slightly higher mortgage rates. Here's where most of the commentary stops. These are some angles many aren't leaning on hard enough that I thought I should talk about. We're seeing stronger growth and inflation risk put pressure on bonds, and not in a good way. Remember, mortgage rates are closely tied to the bond market. The fact that GDP was revised upward and jobless claims are tighter is rattling bond traders more than rate cut expectations. It's a reminder, growth surprises inflate the yields. They don't suppress them. Markets are starting to doubt the Fed can cut 2 more times this year given the data. Keep in mind, Jerome Powell was not exactly confident in stating for sure there would be 2 more cuts. That was more of an assumption by markets, media, whatever you want to call it. That nuance matters. If markets recalibrate to fewer cuts, yields creep upward. That again means slightly higher mortgage rates. Mortgage bond spreads are under a little bit of pressure right now, and even if treasuries don't tank, the extra spread cushion has thinned a little bit. That puts more sensitivity on mortgage rates to small bond moves. And one of the often overlooked tools, which I've talked about in detail before, reinvestment or balance sheet flexibility. There's a suggestion in the market that instead of aggressive rate cuts, the Fed could lean towards modifying how it treats reinvestments or MBS holdings to stabilize housing. PIMCO was one of the notable ones actually mentioning this. This would directly affect mortgage rates separately from the Fed prime rate. So here's what I'm watching heading into next week. We've got a PCE inflation report. If these soften, they could allow some relief. If they surprise high, it'll feed higher treasury yields. That could actually push rates up even more. We have some treasury auctions, and we need to look at the demand. If there's a weak bid on the 7 or 10-year auctions, this will stress yields upward. There are some Fed speeches. We want to look at what is said as well as the tone. If Fed members lean hawkish, meaning no hurry to cut or they're worried about inflation, that gets priced into the bond market really fast. Mortgage-backed security reinvestment signals. If the Fed or agencies hint at a shift in strategy, that could be a backdoor housing relief lever. Again, the reason why rates dropped during COVID wasn't directly related to the fact that the Fed cut the prime rate. It was because the Fed was buying mortgage-backed securities on the open market at inflated prices. This means banks could do loans at lower interest rates than they normally would. Right now, the Fed is not only not buying loans, they're actually offloading a lot of the loans that they bought during that time period. That means they have to charge a higher interest rate because there's a smaller pool of buyers. It needs to be attractive to investors to want to buy these mortgages. Rates are not just about what the Fed says. It's about what the bond market believes the Fed can do, how clean the data looks, and what tools are still in play beyond the Fed fund rates. If you want to know what that means in terms of mortgage rates for you, feel free to reach out or comment, and we will talk about your specific scenario. I have many happy customers for home loans in Arizona, Oregon, and Washington. More than happy to help you out. Till the next one, I'll talk to you later.